Now, we've done this session a couple of times at MIPIM, so maybe just to start with, Martin, what are some of the big changes that you've seen since 12 months ago in terms of capital flows? I know you've just come back from Tokyo, and last year we had a discussion about, is 2016 going to be the time when Japanese money is going to be coming in substantial amounts into the market? What's your kind of sense on changes, and also maybe share some of the experience from Tokyo?
I think the obvious big things that have happened in the last 12 months have obviously been political, and I think that's disrupted investors' strategies when it comes to thinking about where they're going to put money globally. There's also been calls for people to stop and think. I think the feeling we have at the moment is, whereas investors had a strong preference for the US, I think some people are now questioning that, because the US is obviously very late cycle. We've seen some very strong numbers in terms of property returns from the US for a number of years now, and I think people believe that Trump is probably going to be positive for that economy, but I guess there's just a question mark about the longevity of the performance that he can create given what's happened already. So I think we are seeing increased interest in European real estate compared to 12 months ago. And perhaps that's because we tend to be at the core end of the spectrum, or the income-focused end of the spectrum. And that's probably been an additional shift, is that there's more people who are interested in core income-producing real estate. So we're seeing a number of investors looking at that pan-European core strategy, which we hadn't seen 12 months ago, some sort of new entrants who are attracted to that proposition. I think in terms of the UK, it's obviously been a bit stop-start. I think my sense is there's a lot of capital which is sitting, waiting on the sidelines to come into the UK, partly attracted by the currency devaluation, but it's just looking for a bit more clarity around how our negotiations with the EU actually progress once we actually start those. But I think, certainly on our side, we've seen new capital coming to the UK, so we've seen substantial new core capital coming to the UK. People who've never been here before. So I think that's a positive sign. But as I say, there's a lot of other capital circling. In terms of Japan, so I was there last week, as you said, and we've been in Japan for probably 2.5 years now, talking to investors there, and there's now a real sense that something is about to happen. So we are seeing Japanese investors actually starting to make some small investments into fund vehicles, but also some of the larger investors also gearing up to start looking at investing directly around the world, and that is a very substantial source of capital. So I think it's going to be, I think they're going to be a key investor in the next few years around the world.
Okay, good. And Richard, in terms of your experience of, Martin says that he's got interested investors, capital who are actively looking at the UK for the first time, which is an interesting point, I think. What are you seeing in terms of those capital flows, both into UK and Europe? Are you seeing changes, new investors coming in? What's your sense of it?
I think, talking from a UK perspective and an Asia perspective, obviously Q2 and Q3 last year were very, very quiet around the referendum. And then we had this massive resurgence in Q4 with a lot of new entrants, as Martin was referring to. The London real estate market is so dependent now on the Chinese and Hong Kong capital that's coming out, and a lot of that is more family office type capital, more than the insurance companies and the state-owned enterprises, which the Chinese government is very wary that they're going to buy badly, like the Japanese did in the late 80s. They're waiting for the RMB to stabilise a bit, and they're trying to stop all the fraudsters, but they've all preempted this. They've all got their money in Hong Kong, and they're getting it out. It's interesting that it's new capital that's never been to London. It's very looking for trophy type of assets. I was in Hong Kong last week and Singapore, and the Hong Kong capital wants to get into prime residential in London again, which no one's been looking at for the last sort of 18 months, but smaller scale. So I think it's very positive for the UK. In terms of Europe, I think from an Asian perspective, it's still very Germanic I think people are a bit wary of what's going on with the French elections. There is some capital that wants to go to Paris, and even though we'll see capital go into Spain, go into Italy, from the Asian perspective, it seems to still be very, very focused on Germany and UK, I would say.
Okay, good. And Tom, in terms of the capital flows that you're seeing, are you seeing any particular trends that are different from last year, maybe that have been linked to the political risk aspects? What are you seeing?
Yeah, I think the big turnaround, if you sort of take a step back from the individual capital flows and look at the bigger picture, was that Germany was the biggest investment market in Europe, according to our data last year, and over to the UK. So you saw about a 40% drop-off in investment volumes in the UK. Whereas that drop-off, there was a drop-off, as Damian's already said, in Germany, but it was significantly lower than that. And also, if you look at the deal flows, the number of deals that happened in Germany last year was actually at a record level, so much higher than it was even back in 2007. So I think that's kind of a big kind of story for us that we've talked about in the market. It's the first time we've seen Germany overtake the UK as Europe's biggest real estate investment market, and that's clearly linked to what's happened around the vote. And the UK was, I think it was probably towards the top of the cycle anyway, before the vote was even in the sort of a glint in David Cameron's eye at the sort of end of last year. So I think that kind of precipitated something that was already happening in the market.
And are you beginning to, in terms of tracking it, are you beginning to see some of the things that Martin mentioned there, where you're beginning to get newer investors coming in, maybe because they've got a different perspective on the risk now, because there's a sort of certainty of what, a worst case scenario in a way?
Yeah, I think if you look at the investors in London, in central London, I've been showing a chart to some of our clients, look at the top 10 buyers of central London property in Q4, there's a list of names on there that very few of them recognise, because as we've already discussed, it's some of the smaller players, money coming out of Hong Kong. And then you look at who's just bought the cheese grater building in the city, CC Land, and that's their second London purchase. They made their first London purchase in sort of January, February time. And then they've now just spent 1.15 billion on the cheese grater.
I think it's quite interesting in terms of the reasons why money's coming to the UK, though, because there's both what you might call flight capital, so capital that wants to get out of somewhere for a particular reason, and London's always been an attractive place to invest. We've definitely seen that recently. There's then slightly more value add or opportunistic money, which seems to be waiting in the wings, expecting their prices will fall. Be interesting to see whether that happens. So they're attracted by, I guess, some of the downside risks associated with Brexit. But then we've also seen capital coming to the UK, which is long-term core income-focused capital, which is buying the fundamentals of the UK and expecting that there will be continued rental growth in many markets. So it's quite interesting the different views that people are taking, the different reasons for coming to the UK.
And Valerie, in terms of, you're obviously based out of Singapore, and so you're seeing what the capital there is interested in doing. What's your sense of how they're viewing, particularly Europe, I guess, in terms of their appetite for investment versus the USA, Latin America, Asia? What's your sense of that?
Well, traditionally, the Asian, and I'm talking about Southeast Asian money, would invest and buy in places that they're familiar with. So UK and Australia are usually the top choices. Often because, they studied there, they come back, they go back there and they buy buildings. And that will continue. So when I talk to some of our clients, I say, after Brexit, what happens? Do you continue to be just as interested? And the answer is yes, because they're very long-term view in terms of these markets. What is interesting now is because the capital values in Singapore and Hong Kong particularly are so high, and we are flush with cash. Asia has the happy problem of too much money chasing too few products. We are turning our minds to Europe, where they see a lot of value. And generally speaking, they would look at the gateway cities. Why? Because places which are a bit too far away, Central, Eastern Europe, are places where they're not familiar with. So a bit of education is required before they can get the kind of interest. So the initial forays would usually be to Germany, perhaps France, and some of the capital cities, so to speak. And the kinds of inquiries we've had where we connect our clients, and these clients would be developer clients, family offices, funds, from Asia, the kinds of inquiries we're getting and the volume is very much picking up, at least over the past 6 months to 9 months.
And is that looking at continental Europe generally, or in terms of the UK, because they're long-term investors, then actually they're happy to just buy into a story because London's been around for 300 years as a leading city? Are you seeing, is there an overall increase in appetite, and are they choosing Europe over the States, do you think? What's your sense of how they're thinking about where they want to place the capital?
Europe over the States.
Apart from the Chinese.
Apart from the Chinese, yeah.
Okay.
Who love
So
the US.
if you talk about China, it's a very different perspective than, say, Southeast Asia. The Chinese have bought everything there is to buy in the traditional cities, including Singapore. They've basically bought all the nice buildings in Australia. And when you talk to them, in fact at MIPIM, one of our large Chinese clients is here, they're looking in particular European cities, France, it just happens to be an example. The US is actually fair play for them. In fact, even for the Southeast Asian clients, they have gotten into the cities like Los Angeles and New York to buy, and they like to buy trophy, assets, put their name on it, and say that I've bought something. Why? Because 400 million for a building is cheap compared to what you have to pay for a Grade A building where I come from. So, unfortunately, yeah. So
I always feel very poor.
Yeah. So it's actually a function of a lot of money chasing assets, and Europe is in a happy place because the interest in Europe is very real, very keen, and the appetite to buy is now rather than in the longer term. The wait and see in relation to Brexit, in relation to what's happening, I don't think will stop them. It's just slowing them down a little bit.
And do you think there's any, Damian mentioned the currency, the fact that sterling has dropped. Is that an incentive to people because it makes it cheaper, or is everybody kind of hedging the currency anyway, so it's less of a story for Southeast Asian investors?
I think currency, it's one factor, but not the key driver. What they look for is their view, and it depends on who you talk to. Some people view London as the place that will still have the financial center. They don't buy into the story that it will be hollowed out into Germany or some other places. They still have the view that because these people have studied there 20, 30 years ago, and they feel that London will survive. So for those, especially some of the Malaysian tycoons, they've come up in the local press to say that it's fine, we're going in there because of the values that have gotten down, we think we can get a discount, we're there for the long term. So that's the kind of positive enthusiasm which is a bit unusual in the light of what you read in the global press actually.
Okay, that's good. And Tom, maybe with you, in terms of some of the newer sources of capital, so for example, we had South African capital came in, Brazilian capital, you've got different sources. Are you seeing new sources coming in as well, unexpected sources of capital coming in through deals?
I don't know whether you say unexpected. Europe's now a global real estate market, so it's not surprising. There's a lot of capital coming in from Asia, and it's coming in. Yes, we've seen about €1.5 billion worth of deals from South African players. Most of that's gone into Central and Eastern Europe. So it's not they're relatively small markets, and they've been major players in those markets. But that's not a huge amount when you think that's in the context of 270 billion spent in Europe as a whole last year. I guess the biggest story in terms of a newer source of capital last year in Europe was probably South Korean money. We hadn't seen a lot of South Korean money coming into Europe previously, but we saw quite a significant amount come in 2016. But I think what was interesting to note, what we noted about that was they didn't buy anything in London. So unlike, we had investors from China and from Hong Kong buying in London, we saw South Korean capital instead mainly targeting Germany, Austria, and some of the other Benelux countries as well. And that's certainly a change from maybe the stereotype or the view that people have, which is of gateway cities like London and Paris, which tend these investors tend to target first before moving into maybe the German markets, maybe the Dutch markets, and that was certainly a big change.
I mean that's all to do with the finance costs. They're half of the UK in Germany, for example, so it's very appealing to the South Korean insurance companies. They're happy to pay 4% in Germany with all-in costs at just over 1%, whereas they've got to pay all-in costs at just over 2% in the UK and still have to pay 4%, as I understand it.
So that is obviously a disincentive in a way for the UK.
Yeah.
And Martin, in terms of the, let's look a little bit about also the cross-border capital within Europe. Are you seeing any particular things in terms of that, whether or not we've had a lot of discussion about whether people are looking at just the capital cities or whether there's a move towards taking on slightly more risk and moving into regional cities. Are you seeing anything in terms of those trends, whether that's in Europe or within the UK, in terms of European capital working within the region?
I think in answering that, it's worth just repeating the part of the market that we tend to operate in, which is long-term, income-focused, core-to-core plus. So that probably says something about the types of investors that we work with. So they will tend to prefer to be in capital cities, gateway cities, and then perhaps by exception in some of the secondary cities if you think the prospects are particularly strong. I think the continued trend we're seeing within Europe in terms of the cross-border flows in Europe is those larger investors who've had a very concentrated portfolio in their domestic markets continuing to try to diversify into other countries, either through fund investments or through separate accounts, joint ventures and so on. And I think actually that's a continued reaction to what happened in the GFC, because people realised actually having so much money in their own country was a very concentrated risk. So I think that's something we're still seeing today, and I think it's something that we'll continue to see going forward as well.
And Damian, in terms of some of that cross-border capital flow, there's obviously money from the Nordics that's been active. What are you seeing in terms of that, in terms of some of the sort of sovereign wealth fund kind of activity? Are you seeing more kind of appetite for going cross-border and picking up the kind of diversification?
I mean, I think one of the factors as well is there's maybe a diminishing amount of product for sale, so they're having to move around and diversify in terms of where they go to get deals done. I mean, the other factor is, I think, the return profile for all investors is dropping as well, because I think it has to align with a kind of lower for longer period in terms of where yields and returns are going to be. And I think one of the big SWFs, Norge, have dropped their total return target to 3%.
Yeah.
Which they're the third biggest global investor, and if they've dropped it to 3%, that's a marker for where the rest of the market's got to follow. And all types of investors' return profiles are having to move down accordingly. And they've got to do that to get deals done in the markets that they want to be active in as well.
I think one of the other factors that's driving those cross-border flows within Europe is a lot of big investors are still trying to upweight to real estate.
Yeah.
A lot of big institutional investors. And then they look at their portfolio and think, well, I own everything domestically already. It makes sense if I'm going to upweight to then diversify a bit more internationally. And I think as the real estate allocations have increased, the asset allocation teams and then the real estate team have thought about how they're actually managing the real estate portfolio, and they're trying to manage it a bit more like, say, their equities portfolio, where you have got that international diversification. It's not just sort of a small part of the portfolio in a local game anymore. It's being treated in arguably a slightly more grown-up way, if you like.
And do you? I mean, that's got to be based on the idea that interest rates are going to stay low for still a considerable period of time, really, because
the drop in fixed income.
Yeah.
For real estate or real assets and alternatives.
Yeah. And that's been
also then pushing more into equities to help balance out the sort of transactional activity.
And that's been happening for a number of years, obviously, but there's still a lot of organisations which are still on that journey of trying to increase their real estate allocation, despite the fact that interest rates may opposite rise in 5-10 years time, nobody knows for sure. I think the consensus expectation for Europe at the moment is 38 months until the next interest rate rise. So, generally people think it's some way away, and it's probably going to be a relatively modest increase. So in that context, real estate still looks at least fair value, if not good value.
So in terms of your view on the market, in terms of the strategy, is that you're not building in any significant interest rate rises, either in the UK or in Europe, really?
Yes, I mean, obviously if you're looking at buying something today and you think about a 5-year business plan or a 10-year business plan, then naturally you're going to build some degree of expansion into the risk-free rate compared to where you are today. You have to do that, but I think it's probably dangerous when we do reach consensus, isn't it? But I think
always is.
generally I think people have reached the consensus that it is obviously lower for longer, as everybody says, but when that increase does come, it's probably going to be relatively modest, particularly in Europe, including in the UK.
Okay, good. I wanted to pick up as well some of the sector ideas that you brought in there, Damian. In terms of, let's do Southeast Asian capital first, which is, I mean, Richard mentioned high-end resi is something that some people are looking at. Is there a view on, we favour office versus hotel versus logistics versus, is there a natural kind of sector that capital is looking for, or is it across the market and it's really, so for example, logistics is often seen as a much more bond-like performance in a way. What's your sense of that, Valerie?
I think because the residential property values have peaked or are peakish, the tension has been moved towards the other sectors. What has been sort of fashionable in the last a year or so has been logistics, industrial, which the yields have been a bit better than residential, but office commercial is always the main favorites. Because of the strong capital values, and it appeals to all the core and the core plus funds, including the developers. So when they come out of Asia, Singapore, to invest elsewhere, what they do want to buy is a nice office building somewhere in a capital city, which would have very good tenants in the medium term. So that's really the first thing that they will put their money in. The more special interest type of place would be in workers' dormitories, student housing. For some reason, that's where quite a few of the smaller players think that they can get a bit more entries and upside. And senior living or retirement living, which is a very hot topic and something which I think has just only started not too long ago in Southeast Asia, Singapore, Malaysia and Indonesia, based on the inquiries we've had to pitch for proposals, because that's something which has sort of like dawned upon us that, maybe the population around there is getting older.
It's quite interesting. We did a session here yesterday on student housing in the PwC ULI investors' intentions list had moved to the top for the first time, and also we did then within that session there was quite a big discussion about where things were moving, because you'd also got micro living, which is not dissimilar to student housing, which is not dissimilar to senior living, and often in the same place with the same kind of design almost. And whether or not we're moving to a more kind of US multifamily idea, which I thought was quite an interesting section for it. And Richard, in terms of the trip that you did, in terms of sectors, where was the interest? Was it in the office space? Was it logistics? Was it?
Yeah, I was in Hong Kong and Singapore, and it was very different. So, as I said, Hong Kong was very UK, London centric, West End offices, and as I say, going into small scale prime residential, as we've seen the land values really depress over the last 18 months there. Singapore was far more, stable income offices, but with a bit more yield. Want to go into Germany, as well as expanding and remaining in London. But also the urban logistics came up a lot, and student housing, I would say, were the sort of favourite sectors from that region.
Okay, good. And in terms of, we talked a little bit about political risk, and Martin, it's probably not it may well be that Hungary is too far for M&G, I don't know, but it's quite interesting. We were in Budapest a couple of weeks ago doing a session there, and that very much picked up that idea of actually nothing much has changed in terms of Hungary, but it's stable, you know what to expect. Do you think there's going to be more of that kind of thing as political risk emerges elsewhere?
I think generally what we've been discussing with clients most recently is there's a difference between the political concerns and noise, if you like, and some of the fundamental drivers of certain economies and some of the fundamentals of the real estate markets. You obviously can't ignore the political risk, and it's probably most acute in the UK at the moment as we transition out of the EU. And inevitably there'll be some knock-on consequences for the UK economy, some consequences. And I think you've got a similar concern now in certain parts of Europe, whether that's Netherlands or France, in terms of the potential for the political situation to then have a knock-on effect into the real economy. But I think when we try and translate that political noise and concern through into what's really driving these underlying real estate markets, and particularly when we look at supply and demand fundamentals in most of the key cities, actually it's still quite a favourable picture. And I think partly because of that, but partly because there's so much sort of political tension, political noise around the world just now, I think investors are starting to get used to it.
Yeah.
And I think they're starting to accept that it's just part of the investment landscape today. And are you actually going to step back and say, I'm not investing at all because of that? Probably not, particularly when you've got this fundamental driver that the asset class still looks attractive. So I think the main point I'd make is that there's often a difference between the political noise, which can have some economic consequences, and the fundamentals of many real estate markets, which today are actually quite good.
Good. And from your point of view, Tommy, we mentioned there cities, and one of the things in the discussion yesterday on human capital was clear that cities were kind of moving towards where investors were looking at, rather than necessarily countries. Are you seeing that clearly through the sort of data that you're getting, that it's focused very much on specific cities rather than countries? How are you seeing that?
Well, I guess, we track real estate from the property level upwards, so, it depends which lens you want to look at it through. Do you want to look at it at a country level or a city level? I think certainly the message we get from our clients when we go and speak to them and reading their literature and some of the stories that come out in the press is that people are focused on cities. So TH have got a European cities fund. They're about to launch an Asian cities fund. Schroders are targeting certain European cities. Same for Standard Life, people like that. But actually, if you look at the numbers, because you hear this and I think okay, right, I'm going to go and delve into this using our our database. Actually, the top sort of 20 European cities are not accounting for a greater share of the investment total than they have done previously. So actually, there's a lot of noise about it. But when you look at, yes, they're attracting a lot of capital, but it's not necessarily more capital than they were back in 2007, or or in 2015 or 2014. But that's certainly, the noises that we're getting from investors.
I mean, the people I speak to, it's the good old word liquidity, and at this mature part of the cycle where we are in the European real estate, and I know in certain countries it doesn't feel as though they've really started recovering, but we are at a mature part of the cycle that people are very wary of getting stuck with an asset for the next 4 or 5 years, having to work it out. So I'm seeing the capital come back into the capital cities, and if it has to go up the risk curve to meet their returns, they'd rather do that than go out to the secondary markets and get found out.
There still is, just to agree with that, there still is a significant pricing gap in our numbers between sort of CBD offices across Europe and what you call suburban, and the same for sort of core markets versus the secondary and tertiary. But you're seeing, places like Nuremberg and Leipzig in Germany, which are not really what you call the core European markets. They've seen investment growth this year, in 2016 of 100%, 80% increases in investment volumes. So their capital, yes, investors want to target those, Germany, cities, Paris, Stockholm, etc. But I think competition for assets is kind of pushing them out. And even in somewhere like Leipzig, you're getting 10 or 12 bidders for assets. which you weren't maybe 2 or 3 years ago, and that's pushing some of those investors out of those markets.
Am I right or wrong, Martin? Have you done a regional UK fund recently?
Not a fund, but we invest throughout the UK. So we've got 19 billion under management. So London is obviously a material part of that. We invest across the country in all cities. I think just listening to what we've been saying about the investors' preference to be back in those key cities, it might be partly to do with the liquidity. I also think it's partly to do with the fundamental drivers of occupier activity and this renewed preference in Europe, at least, for people to want to live and work in city centres again. And whether that's in London or whether it's in Manchester or Birmingham, we're seeing occupiers being sucked in from surrounding areas into those cities because that's where their staff want to be, because they want the amenities, they want to be able to walk to work. They don't want to be on that business park, 3 miles out of town that you have to drive to. So I think investors seeing that trend, what occupiers want and what their staff want, is starting to drive investment decisions as well.
That feeds through as well into the property performance. So in the US we produce a lot of price indices. We divide the office ones up by the walk score of the buildings. So highly walkable buildings have significantly outperformed suburban offices in the US, and I think that's a trend we're definitely seeing in Europe as well.
I was curious about the dip in volume because it doesn't square with everything we've been hearing. Where did that dip come from?
Dip in volumes in
Yeah.
EMEA?
Yeah.
I think it's political uncertainty where investors are thinking, okay, let's just hold off, see how things figure out. But it's also lower pricing and lack of product available to buy. So the capital is still there wanting to go in, but it's waiting to see how the politics are shaping up.
I mean,
And it's also
gone
reflecting
are the days in London where you bought a property in 2013 and flipped it in 14. So I think there's not as many sellers or willing sellers, which I think affects where we are as well.
Institutions are holding assets for much longer. So there's less assets coming back into the pool. So that's why you've got to develop.
I would have a question to you. Are the investors, the Asian investors, very often investing in the European market on themselves, or are they partnering with local asset managers? Because I've seen both, and I'm always quite question how someone being in Asia, having the Excel sheet with perfect figures, can really have a long-term investment in a German, like Frankfurt suburban area. Looks like Frankfurt, it's not Frankfurt, but this is very dangerous type of investing procedure. So do you see many investors doing this, or are they more partnering?
I think Asian investors, they're very savvy, so they're not going to do something risky like unfamiliar places. So the top choice is always a gateway city, top tier city, and good quality buildings. And they would partner with a proper asset management or maybe a JV partner. So that's really the first choice. Then in terms of going beyond that, no, I don't think there's a big demand to go beyond those that threshold, for the simple reason that there is a lot of choice. So if Europe is your playing field, right, there's no need for you to go into that. The yield is something which is attractive, but we're so used to 3% that anything above that is great.
I mean, I would add that the South Koreans are having more success in Europe because they are partnering up with a Patrizio or a L'Etoile, and it's giving the seller more comfort. Chinese generally, Asian, and I don't want to offend, are not great JV partners. They like control. And I think that's why we're probably not seeing as much success from, say, Singapore or China, because a lot of those guys are still trying to do it on their own. But I think they're starting to learn that maybe they do need a partner.
Being a banker, at least it gives me comfort knowing there is someone partnering.
But I assume you're in Japan all the time trying to pick up, because I think the Japanese will go through an M&G or a
Just
UBS.
M&G,
Only M&G.
No, I think I should
Apart from Mitsubishi.
I should add that we have some very successful partnerships with Asian capital. I think we're definitely seeing an increased activity in our business in terms of separate accounts, co-investment activity, and that's working with international capital who's not come to Europe or the UK before, who don't have teams on the ground. But not all of them want to do that. I think it tends to be the institutional sources of capital want to do that, who want to partner with a local manager, whether that's just the local manager putting money into the deal, or whether it's actually through a separate account, so a client and manager relationship. So that's the institutional investors. I think the sort of private money or the corporate money, that's less concerned about that, and I think is more happy just to find something they like and just buy it. And then the sovereign wealth fund money is probably a bit of a mixture, because they probably feel certain things they can do themselves, but other times they're happy to partner with people. But obviously we would advocate partnering with the manager.
Good. Any other questions or any other thoughts?
Question. My company's actually a tenant of the cheese grater, so we're waiting for a new landlord at the moment. So that's in the mix. Waiting for the deal to go through. My question was about North Korea, and we talked about sort of noise as opposed to something that affects fundamentals. But as we're hearing, North Korea's kind of reached peak craziness in terms of what could possibly happen. Obviously, that's affecting Japan and everyone in that region. Is that impacting real estate investment in terms of there's so much investment at home? And are people thinking, well, they'll move money else, or is that just part of the noise?
We see more inbound into Korea because that's where the funds are channeling the money. In terms of money coming out, not the kind of volume that perhaps maybe you can talk more about it, but not so much in Southeast Asia.
So that geopolitical risk isn't necessarily, people don't.
Yeah, no, I mean, we've just done some research in Asia of is 2017 going to be the year when Asian outbound comes back inbound? And the summary was no. Probably in late 2018 and 19. I think the need to diversify the effect that everyone's linked to the RMB over there, I think is driving it more out. I mean, I don't know the answer to the North Korea thing, but to me it's just more, we've all got our eggs in the same basket here. We're all in Asia, and we need to diversify and get our money out into the US and into Europe.